Today is a continuing conversation that's been going on now for a year. 12 months ago, 8 months ago, Sasha and I sat right here and asked a question that made a lot of people feel uncomfortable, including us. Is real estate too big to fail, or could it actually happen? Sasha and I explored three possibilities. Are we in a quick rebound like we usually see? Are we in a long term stall like some economies that will never recover for decades? Or are we in a slow grind? And here's where we landed. We are in a slow grind, a unique situation of getting back to our normal in real estate investing. It's not a collapse, it's a period of friction. There's frozen confidence out there, there's sideline capital, and there is policy that just cannot translate into movement. And so I have someone here that will continue the conversation. We always have a lot of fun. We've been doing this for over a decade together, Sasha and I. Sasha leads Greybrook Securities, one of the leading developer and capital providers in the country. Over 115 projects on the go right now, over 45 billion in assets under management, all across Canada and the US. Different projects, different asset classes. So nobody better to share this conversation with than Sasha. And I'm going to bring Sasha on in a moment and ask him a very maybe not difficult question, but we're just going to get it. We're just going to kick it right off here. And I do have some personal questions for him. We had some fun in our pre-show, but let's just get to it. Let's recap what Sasha and I talked about last time. I made some notes here that I'm gonna talk to you about this slow grind. You know, the cause and the effect, because we came to the conclusion last time that this grind is not caused by fundamentals in the macroeconomics of the business of the market. It's caused by this sort of perfect storm, this synchronized hesitation across capital, consumers, institutions. Like everybody is just waiting to see what's happening. It's not one dramatic macro factor like we usually see throughout history. It's this very complex, multi-layered freeze across all of these market stakeholders and participants. And so I went back and I watched our last event. If you haven't watched our last conversation, we'll put links here wherever you're watching this. We'll put links if we can. You have to go back and watch our last conversations because it all connects. You can start to see the narrative and the story of what's happening as Sasha and I bring you through this world called real estate investing. But here's the four things that Sasha and I talked about last time that we figured out. Okay, number one, I wrote these down as I rewatched it. Institutional capital is waiting. So institutional capital, the big guys are sitting on the sidelines and they're waiting to see what happens. And the institutional capital starts to invest quietly in the background. And that is what really starts this momentum shift. Number two, transactions are frozen across all buyer types. So institutional buyers, they're waiting for the data. They're waiting for things to happen. Investors are unsure about timing. They don't have the confidence, and there's a lot of uncertainty now. The move-up buyers, this is people that are upgrading their homes. They don't want to give up their low mortgage rate that they have right now. And first-time buyers, they're super payment sensitive. They can't actually afford the payments, even though the interest rates have dropped a little bit. That's number two, transactions are frozen. The third thing we talked about is the cost structure reality, the math of development. New supply is just expensive to build. There's development charges, there's municipal costs, there's construction cost inflation, financing costs, government friction. All of these things are leading to this, the economics of development being much different than they were in any other environment. And number four, and the people that I've talked to between my conversation with Sasha and now believe that this is probably one of the most important things is policy friction and execution gaps in what the government is saying they're going to do and what the government is doing. Municipal approvals remain slow. Federal and provincial governments are really slow to move. Development charges remain high, which again, it contributes to that math issue. And this red tape hasn't really disappeared that we have in the bureaucracy of getting units out there to market. So today, we are not going to debate whether we're in a grind or not. We've come to that conclusion. Today's question is more important. What has changed since the last time we talked? So Sasha, welcome today. I want to pick up the story right where we left off. Are we still grinding right now in the real estate market? Or are we beginning to see some first signs of a momentum shift?
Um, Firstly, thank you for having me. I always like
We
chatting
forgot you.
and
Oh,
connect.
Sasha, I don't hear your audio.
Oh, okay.
I don't hear your audio. There we
You
go.
don't hear me. One
While
sec.
Sasha's getting that
Michael,
worked
we
out
can hear Sasha.
in his new studio, welcome everyone. Great to see you, Roy. Great to see you, Frank. I see
Uh,
Corey. I see Caroline.
it,
Welcome
it looks
everyone.
it looks
Was
like
just working a minute ago.
you still can't hear me,
Sasha,
Michael.
hey, turn off your microphone while we get set up here, and of course, that always
Yeah.
happens.
Hey, Richard, maybe you want to tell him it's on Michael's end
So, hello
because
everyone. Oh, Michael, we can hear him. It's just me. Sorry, guys. All right, my team is telling me we can hear him. Sasha, over to you, buddy.
okay. So hopefully we can sort that out.
I can hear
Otherwise, it
you
could be a
now.
big monologue.
Yeah, yeah. No, I
Uh,
can hear you now. Here's the thing. My computer was on mute. There's good technology right there. There's good
oh well,
technical
there. See,
skills.
look, we have figured it out. We're already solving problems today.
I got all this technology and it's on mute. Here we go. Deanna, thank you for that. Sasha, sorry for that, buddy.
Excellent. No, I was just thanking you for having me. I always enjoy chatting, connecting, and kind of seeing if we can see our way through the storm, come up with some good ideas and things like that. So, kind of to get into your question on has anything changed? Uh, it's always changing, and I think since we spoke last, things have gotten better in some sense. Things have gotten less certain in other ways, right? I mean, I woke up a week ago to, a bunch of countries bombing one another, and that has impact on consumer confidence and sentiment and all these things. At the beginning of last year, there was tariffs, and then there weren't, and then there was, and then there wasn't, and then there wasn't, and then there was, like it's just changing all the time. So it's hard to make sense of it, but you said something at the onset, which I've been very adamant about whenever I get asked, is talking about fundamentals. So there's several macroeconomic factors that are impacting the market today, and buyer sentiment, investor sentiment, both institutional and otherwise. But the fundamental need for housing exists. And so when we talk about fundamentals in markets, we're looking at certain trends that are very difficult to disrupt. Most specifically, we look at the supply demand dynamic and the fact that in most cases, in every case where we invest, there's a demand that simply can't be met with the supply of inventory coming to market at whatever pace it's coming to market. So that disparity or scarcity is a fundamental factor that over the long term tends to lead to stable upward uh, progression in value. Okay. And from land right through to the end product, that being housing. Now, there's a lot of stuff in between. Okay. There's policy, as you mentioned. There's what happens to the cost of things. We're in a production business predominantly. So it's not always about what you're selling it for. It's about what does it cost to build you and what does that margin look like? And clearly, where we sit today, with all of the things that have happened, one of the biggest factors is an affordability challenge that Canadians feel when it comes to their ability to access housing, whether that be rental or through purchase. And there's a number of reasons, right? Interest rates, mortgage rates, the growth of incomes relative to the growth of housing prices. There's a number of these variables, but at its core, there are two ways to potentially fix the problem. One of them, of course, is a rebound in price, because today, as developers sit there and as investors sit there, the math isn't mathing when it comes to construction, right? Because what I can sell something for today, relative to what it costs me to build it, there's no margin to be had, which then renders it unfinanceable, and there's a number of reasons that it can't move forward. So to get out of this, it requires kind of one of two things to happen, or maybe a combination of the two. One of those things could be a rebound in price. Okay. How does that happen? Well, part of it is driven by improving macroeconomic conditions. Part of it is driven by lower interest rates, which give people access to, another incremental dollar on their mortgage potentially, as well as some confidence. Because, right now we're locked up in this market where sellers, as you mentioned, Michael, aren't keen to sell at this particular point in time, and buyers aren't abundant. So you have this market that's kind of on lockdown, and when that starts to unlock, it causes a change of sentiment and causes a change in confidence, which means that when somebody's selling a home, they can actually rely on being able to sell it in a timely fashion and at a price that they've accepted, and that means they can transact on something new. Until that happens, it's very, very difficult to get that market going. But when it does, sentiment begins to change. So there's a number of demand side or what I'll call revenue side variables that can push up price. But more importantly, some of that stuff is outside of our control. So where are we trying to focus? We're trying to focus on looking at the other way to restore margin, and that is by trying to reduce the cost of construction. Part of that happens naturally because there's simply not been a lot of construction, right? So when there's not a lot of construction, there's slack in the system, as I would put it, whether that be through labor or the infrastructure that's required in construction, and that starts reflecting itself by costs coming down over time. Okay, so that part of the margin equation or the margin sandwich is starting to come down. Land costs. If we're acquiring something new today, in today's market paradigm relative to 2 years ago, when you're doing the math on acquisition, obviously you're not willing to pay as much as you were potentially 2 years ago, reflective of today's economics. And in some cases, you're starting to be able to transact on land because sellers have started to slowly adjust their expectations in some cases. And in others, they're forced to sell because they might have a mortgage that's due that they can't refinance, or they've held on to the property as long as they can. So that is allowing you to reduce the cost over time. And then the single largest factor, as you mentioned, and this centers around policy, is development charges, taxes, other levies that, whether they be municipal, provincial, or federal, that the government has complete control over, that could potentially take a significant amount of that out of that cost equation. And what that would do is allow developers to not just make more margin. Yeah, we all want to make more margin, but it's going to allow us to meet the market at a lower price point, right? And then that sort of starts solving that affordability issue. And I think we're getting really close relative to 8 months ago on some major steps by the provincial and municipal governments, for sure, in addressing some of those things, particularly in the GTA as it relates to development charges. The federal government is working to, let's say, refine some of their HST legislation. All of this is going to work to sort of reduce the cost and help get shovels in the ground again. So to answer your question on what's changed and where we're at today, I think we made a lot of progress. It doesn't move very quickly, right? But it's certainly moving in the right direction. And I'm in contact with all different levels of government on these matters. And they haven't finalized things yet, but they're making a tremendous amount of progress. And I expect over the next 2 or 3 weeks that we'll see some new legislation that should help improve that calculus for the developer. Does that get us all the way there? In my opinion, no, because again, part of the game is sentiment. Part of the game is the resale market starting to get unstuck. So I think this will go a long way, but we still have a bit of a ways to go in terms of the overall improvement in the housing market, both for the GTA as well as abroad. And in my answer here, I'm giving you my perspective on Canada. I have a bit of a different perspective based on what we do in the United States, which we can touch on. But that's more or less, Michael, where I think we stand today. So if I'm an investor listening to this, I'm sort of thinking, okay, we're not 100% of the way through this cycle, down cycle, but we're not 50% of the way through. We're somewhere between, I would say, 70 and 80% of the way through. So we got a little bit of a ways to go, but things are moving in the right direction. And I always take it back to the fact that at some point, at some level, we need more homes. They need to get produced. So something's got to give, and we're getting to that point, and we're getting to the point where finally different levels of government are finally realizing that it's kind of on them to be able to make the first move.
Okay, I like the way that you've put us throughout time through this grind, and we shared the stage back in November at a mastermind, and we talked about this being a bit of a war of attrition for business people in general. And I'm gonna let's stick to Canada for now. I would like to talk about the U.S. because when I talk to our U.S. Keyspire members, it's a very different picture they paint. But in Canada, we talked about this being a war of attrition, and whether we're 50 or 60% through or 14% through or 95, it's the point is people are dropping off left, right, and center. Whether you're a mom and pop, buying one income property, or if you're a big developer or builder deciding not to be in this business anymore, we came to the conclusion that those who continue to move forward, those who can get through this, are the ones that are going to be left standing at the end of the day when there's the same amount of resources, but half the number of people. And I know from you and I, our goal is to be the ones left standing. And, we're speaking to people that if your goal is to be the ones left standing, these are the things that we want you to think about, because it is this war of attrition. It is this war of people dropping off. I like the idea. Okay, you said a couple things that I want to highlight for people. There's the development side of things, which is really your world, and then there's the more retail side of things, which has to be your world too, because you're developing things to sell them. But that's a bit of a different story. So let's unbox them both. For anyone who's not familiar with development and what an organization like Greybrook does, as Sasha said, they're more in the production business than the real estate business. Right? They're producing something. There's a margin that has to happen between the revenue and the expenses. And those are the economics that have been shaken on both sides, Sasha, right? The expenses have gone up, all your costs have gone up, and all the revenues have dropped. And that's, our margins as business people can usually handle a little cost spike temporarily or a little revenue drop. But when they both happen, it's such a massive amount for such a long time. That's the issue that we get into right now. And so you talked about the cost side. I I I like to look at the solution on the revenue side even more. Somebody told me, a mentor told me over a decade ago, is in business you can't save your way to success. In other words, you can only cut expenses so much until at some point you've got to increase revenue to be successful. And so in this business, the way we increase revenue, Sasha, is we need people buying properties again. I mean, I saw a stat in the GTA last year. There was like 1,500 condo sales. GTA would do that in like what, a month? I'm not an expert on the stats, but like that is such a low amount of number. Just underscoring my point here that people are not buying, and the transactional friction to me is the secret sauce. Is as soon as we can get people buying again, the costs become less of an issue because people are going to be paying, right? Mm-hmm. So what's your take on like how do we either impact or be aware of that demand side of what people aren't buying today, and when the heck are they going to start buying units again so that this economy can start churning?
Yeah. So I think it starts in the resale market, and because it's a needs-driven market, right? Like investors are always last because it's not a necessity. Capital's mobile, right? Like in when sectors cycle, and this isn't just real estate, this is anything, right? Like look at what's going on right now in private credit. All these funds are taking big write-downs and things like that, and investors are heading for the hills, but the smart ones are not, and the smart ones are plowing money back into certain assets because they know that it's part of the volatility that exists in markets. So investors are usually last. They don't like to, as much as we all talk about being so smart and wanting, I buy low and sell high, right? Except most human beings, that's not mass behavior because people are emotional, people get scared. There's a number of different things and a number of different factors. So what I believe is that the need for housing, which is predominantly at the ground level for end users who need a place to live or a place to rent, they can only wait for so long, right? Because they're of course, people are nervous. People want to make the right decision. They want to feel confident that if they buy something, it's not going to be worth 5% less tomorrow, right? And I think we're at that point where we've seen about all of the retracing that we're going to see on price. And once we see months of stability, which we're already kind of into, I think people are going to say, okay, well now I gotta go now because I gotta go now, right? I'm moving, or the place I'm staying is too small for my family, or whatever the case may be. And then once that need-driven buyer comes back into the market, over time, sentiment begins to shift. And when sentiment begins to shift and economics start to improve with that, right? Not with the sentiment, but with the need-driven buyer, right? It brings stability to the market and forward momentum back to the market and certainty back to the market. Now investors start to look and say, okay, we've hit bottom cycle, things are stable. Now this is making a lot of sense. And they forget really quickly, in a good way, what just happened and start to widen the lens and look at, well, listen, over 20, 30 years, this has been a fantastic place to put money. And now we're at a point in the cycle where I think it makes a lot of sense to put this money to work. And the first to move there, Michael, is the institutional capital. And we're already seeing it in different ways, right? So you mentioned, our focus is development, but we also own a lot of apartment buildings. And part of our strategy is buying apartment buildings both in Canada and the United States. Some of them value add, some of them more stabilized. But the idea here is in that market, it's a heavily institutionally driven market. And we're starting to see transaction volumes come back. We're starting to see more buyers into the market. There were a couple of transactions over the past year where some of these apartment REITs, right, public REITs, were taken private. Well, why do you think that happens? It happens because the people who are on the inside, or the smart money, are looking at the value that the market is ascribing to these public REITs and saying, these things are intrinsically worth way more than the trading price, which is a reflection of mass psychology, right? And they're saying, I'm going to take the thing private now because I'm buying it for 60 cents on the dollar. And then one day when markets improve, I'm going to take it public again and I'm going to make a whack load of money. So you're starting to see that smart money move. Ourselves included, we just launched actually yesterday a new fund that's going to buy apartments because we think cap rates have decompressed. We think it's a perfect time to be buying them. For the same reason, the apartments we hold in our portfolio today, we don't want to sell, and we're doing everything we can to hold on to them longer, right? Because now's the worst time to sell. Well, unfortunately, there's people out there where they have to sell, and we want to be able to take advantage of that and buy at the exact right time. So the answer to your question as to kind of where we go and how quickly, I think that's started already. In the retail world, it's a little slower. It's going to start with the resale market. In the institutional world, we've already started to see a mobilization of capital. And not just in residential. Yesterday, I was reading an article where one of Blackstone's funds that's listed, it's not their industrial fund, I believe it was their office fund, had net inflows, right? It's a largely institutional fund. It had net inflows for the first time since 2022, right? So think about the office sector and what it went through. COVID, nobody's ever going to go to cities again. Nobody's ever going to work in an office again, right? So you had psychology, right? Redemptions, give me my money back. Office is going to become extinct. And now all of a sudden you look at the value of these things relative to what's intrinsically in them. And the smart money is starting to go back in, and they're saying, now's the bottom, now's the time I got to buy, right? So it's not just residential that's seeing that dynamic. You're seeing it across multiple real estate asset classes.
Okay, I love that. And you said smart money a few times. I'm going to just define that. The way I look at smart money, Sasha, is people that make the financial decisions, not the emotional decisions. So, today the smart money is buying because they can get across. It's a business for them. It's just the numbers. They're not encumbered by the fear of the last couple years. They have probably lost, but they're not encumbered by the past. They are looking to the future. So they're saying, if the numbers work out, I'm going to buy. And if the numbers don't work out, I'm not going to buy. And to me, that's what I think about when I think about smart money. Would that be a good way to put it?
I think it is. The one thing I would add to that, okay, so first, of course, emotion. You take the emotion out of it, you look at data, you look at numbers and all that kind of thing. The other thing that I would say, I consider Greybrook smart money in the things that we do. If you ask Sasha if he's smart money as it relates to equities, I'm not. Why? Not because I'm not smart, but because, well, maybe some would say I'm not. But the point is,
Sasha, what do you mean equities for our audience here? You mean
like
like
just
stock market?
investing something not real estate. Okay.
Okay.
Real estate's our expertise. Greybrook's expertise is real estate. If somebody said, "Hey, Sasha, do you consider Greybrook or do you consider yourself to be an expert or smart money buying stocks?" My answer would be no. And it's not because of the emotional component. It's because when you go to work every day and you have an entire organization of 150 people that do nothing but look at data, talk to brokers all day, talk to buyers, investors, sellers, residents, economists, bankers, lenders. Like you can't possibly get data like that if that's not what you're doing every single day. So part of being smart money is the emotion, but part of it is you need to have the infrastructure and the capacity to be able to synthesize a lot of data. And that's just something not a lot of people have, and myself included, right? Like when I look at people ask me, what do you do with your non-Greybrook, non-real estate money? I'm like, I give it to somebody and then I never think about it because that person's an expert and they have the capability to be able to do this every day, and I can't match that capacity. So that's just another dimension I want to make sure that people understand. It's not just about your emotions, it's about having the resources to be able to really understand at a very deep level how markets move and who the different players are, because that's how you time different acquisitions.
Sasha, it's funny you say that. I'm exactly the same as you. I give my my non-real estate money to somebody, and I say, please do what you do best because I am gonna mess this up for sure. And I've tried. I don't know if anyone here have you ever tried like the direct investing apps, Sasha, where you
Yeah, of
get to pick
course.
your own stocks and you get to. I mean, to me, that's casino money, right? It's like I do it for fun just to be able to talk about it and experience it, but I lose more than 50% of the time when I pick my own stocks.
Well, we're all listen, like how do we do it? We heard something about something, or I saw an article or I read it, like because we don't have the time to go into the weeds of
Yeah.
financial statements and interviewing people at the company and doing all that. So I think people need to understand the institutional investor, that process. Like when we acquire something, to give you an example, we have about a 60-day diligence period. And we don't just kind of do math. We're spending $200,000 on every acquisition without knowing whether we're going to acquire it or not.
Hmm.
We're putting engineers on site. We're doing geotechnical analysis. If we're buying an apartment building, we have people that are looking at structural work and all that kind of thing. You're interviewing your leasing agents. You're interviewing your staff that works in the building. You're interviewing tenants. Like all of that is required and it's very labor intensive. So that, to your point, when we invest in stocks, we're like reading an article and saying, oh, I'm going to take a flyer on
Yeah.
this, right? But you know what? The guy that we give our money to, that's not what they're doing. And that's why we give them our money.
Yeah. Yeah. Good. And so I just want to go down the sort of institutional capital because we talked about this in our last session and some people had asked, it's like, Michael, I love that idea. How the heck do I do that? Like, how does an investor watching one of our audience members here today, Sasha, and we have some people from Greybrook as well from your audience joining us, which is amazing. Welcome, everyone. Some people from Keyspire, some people that just met Sasha and I. If I wanted to follow institutional capital, so if I buy into this idea that, okay, institutional capital will move first, these people are much smarter than me. 150 data crunchers is going to do a better job than me on my computer on a Saturday morning. If we can buy into that idea, the next natural question is, well, how do I watch what they're doing? How do I see where institutional capital moves? Is this a matter of, we watch the public companies and read their shareholder reports? Is this a matter of we need some special network? How does somebody watching here be able to be aware of that?
Yeah, I think that's a great question, actually. It's, part of it is like, for example, investors who invest with us, Keyspire members or otherwise, we give them a lot of information about what we're doing and why and all that kind of thing. So to the extent people read it, they're in tune with our thinking as one source. However, I think it starts with identifying who the players are, right? Like if you're interested in investing, for example, in residential real estate, just to use that as an example, okay, well, who are the big players? You have people like us and developers and so forth. Then you have public companies. You have public REITs, right? The Mintos of the world, the InterRents of the world. You have private equity firms, right? You have the Brookfields of the world, you have the King Sets. So it's about zeroing in on who these folks are, and it doesn't require special information. Most of these firms put out a lot of reports. They put a lot of information out there into the ether about what they're thinking. They do a lot of interviews. They do a lot of podcasts. So it's a question of just kind of coming up with a list of who the players are, and then starting to kind of Google search and say, okay, well, let's use Kingset as an example. What is John Love at Kingset doing, or Rob Coomer at Kingset? Did he do a podcast? Maybe I'll listen to it, right? And there's this whole world of podcasts that isn't just the Joe Rogan podcast or the big popular ones that everybody knows. There's all kinds of commercial real estate podcasts. There's all kinds of information out there. And I find for myself, podcasts are the best because you can read an article, or you can, and that's, at the end of the day, a very condensed version of something or a strategy. When you listen to an hour-long podcast of a CEO, I listen to John Gray a lot, for example, who's the CEO of Blackstone. And they're in multiple real estate strategies in addition to other private equity. But a guy like that has all kinds of perspective on the world. They invest globally. They invest in multiple asset classes. And while John isn't the one doing the investing per se, he's on top of the entire strategy. So when you listen to him for an hour, or a guy like Jamie Dimon, who's the CEO of JP Morgan Chase, those guys have a lot of perspective. And where I think people can gain a lot is just to listen to those folks, because they talk about trends, they talk about themes, they talk about what's changing in the world geopolitically, economically, and you're going to hear a whole bunch of things, right? And those help you. Like, let me give you a great example. So we invested in a data center back in 2024. Okay, so it was our first investment in a large-scale data center. And there's a number of reasons we did it. One of our institutional partners is the capital with us in there. But as we learned about the industry, you're starting to look forward, and yeah, data centers are a big deal. But what comes with those things? Power, right? So now everybody's focused on the power infrastructure. So if you look at the Blackstones, the KKRs, the large players in the space who invest, they've turned as much attention to the infrastructure associated with the data center as the data centers themselves, right? So that's a good example of trying to stay ahead of the curve by just watching the big behemoth companies in the space, what they're talking about, the discussions they're having, the themes they're identifying, and then watching, just reading articles about their transactions.
I think that's great. I think everyone should write that down. And the practical write down for your piece of paper is trade 1 hour of Netflix a week for 1 hour of a podcast with a company, a CEO, somebody at that company that is institutional capital, smart money. Define smart money, someone that's smart money, and just listen to what they say. I absolutely love that. And part of the reason that we do this is, you and I bring different perspectives. You have data and a team. I have data and a team. We have our experiences. And the reason Sasha and I just do this absolutely free for all you guys is so that we can hopefully provide some, direction, some insight into what is going on in today's market. I love that. So that was one of the questions I had, institutional capital. Sasha, I want to talk now about, I've seen you on some other podcasts, and I know you're passionate about this in terms of a supply and demand outlook for the next, say, 3 to 5 to 8 years. You opened some of your conversation today with the idea of supply and demand. One of the most important economics in any business, supply and demand, and real estate is not immune to that. Real estate's got like supply and demand, interest rates, and like incomes. Like there's like a couple major macros that underpin all the complexity of real estate market. Anyway, supply and demand. We have so much demand for housing right now. Going back to the point that people aren't buying, we have so much demand for housing. We have people that need homes. We have people that are 3 families in one home. If with all this demand, and you draw a supply and demand curve in year one macroeconomics, prices should be going up, and everything should be great. And so just a question around, like, how does demand and supply work today? But more importantly, what does that mean 5 years from now? If all this demand is happening and we're not building anything, what the hell is going to happen with all these people that need a place to live?
Yeah, your last sentence kind of led a horse to water there. I mean, it's very logical what's going to happen. Like there's no magic here, you know. Like we've paused demand to some degree. Okay. You know, immigration levels have dropped for a period of time. That's not for Canada going to be sustainable, right? Like I go back to trying to kind of your question wasn't about immigration, but I think it's important. The the level of immigration we had relative to our pace of adjustment to that level of immigration, both infrastructure spend and everything else, was mismatched, and it caused a lot of strain. Okay. Having said that, we as a country require immigration to grow. We require it. And the reason is that if you look at our demographics, Canada, generally speaking, was getting older, not younger. People are having less children than they had back during the boomer kind of generation. And that manifests in less population growth than we need to be able to sustain the type of growth and the spend, right? Healthcare, right? Because it's all tax dollars. So at the end of the day, the only way you can start to make a solution is to increase immigration. So that's going to happen again, no matter what. Okay. And maybe we'll do it a little more intelligently. Maybe we'll pace ourselves a little bit better. You know, I'm hopeful for that. But the point of the story is that demand that already exists in this disparity, if you think of today as day zero, we have a giant gap between the demand that already exists. Forget the next incremental person that enters the country or that moves into Ontario. We have more people by far than we have dwellings. Okay. And certain disruptions to the market and people's confidence and all of the things we talked about have led that to just kind of get locked up for a period of time. But it doesn't change the fact that there's a massive gap between supply and demand. So your question is, what happens over the next 3 to 5 years? Well, everything not being sold or built today is one less dwelling in 2027, 2028, 2029. So we are going to have to, as a country, turn immigration back on. It's going to be essential to our growth. And we're going to be doing that heading into an even further dearth of supply, because everything not getting sold and not getting built today isn't going to be here tomorrow. And I'll let you conclude what that will do to price overall, but it can really only go one direction. And what I'm hoping for, this might be contrary to what maybe people think, but people in our position don't like the volatility. Like what we saw in 2020 with COVID, interest rates dropping, all the factors that led to kind of prices going up by 20, 30%. What happens? Well, when that happens, then you see the reverse of that at times. And you're seeing this volatile thing. We don't like that. We'd like to see just stable, like from kind of 2005 to 2019, it was pretty much a stable trend line that reflected the supply-demand disparity, right? A stable trend line of price increases. And then a whole bunch of things over the last 5 years caused that to start getting distorted, right? COVID, interest rates, supply chains, costs, inflation, and everything else. Once we get back to a normal period, we're going to be sitting here with a lack of supply against a growing demand, and we're going to start reestablishing that curve. What I'm hoping for is that it's not a big spike. What I'm hoping for, it's much more orderly and sustainable, which I expect will happen because, again, when those costs come down, but all the things we talked about that are going to help bring those costs down, you're going to be able to get that price to a more sustainable level and then build from there. And I think that that's what we're in for over the next 3 to 5 years. So as we sit here today as a firm, it's a tale of two worlds. Okay. We own a bunch of stuff, as you know. You're invested in it. A lot of the people watching are invested in it. I'm heavily invested in it. And you have to deal with the conditions that have been dealt. Right? We didn't choose COVID. We didn't choose all the macroeconomic stuff. We didn't choose wars. We didn't choose Trump. All of these things. And as a result, we have to focus on what we have. We need to get through it, as we've talked about from the onset, and we will. And I'm actually very proud of how we've handled things, because in the grand scheme of things, when you're looking at the disruption in the market and how deep it is and how profound it is, and every day you open the newspaper and people are going bankrupt left, right, and center, we've dealt with the pain, and we'll continue to deal with it. And as I said, we're about 70, 75, 80% of the way through. But everything else, the tale of two cities, we're looking at it as a huge opportunity. This is now when you start buying, because the next 3 to 5 years, you will be rewarded for that, right? And that's where the psychology comes in. Like when I come to you, Michael, and say, hey, listen, I have a new investment, you should buy it, and it's in real estate. You're a bad example because you're a professional and you can maybe compartmentalize and, the smart money, so to speak. But your general average person is going to sit there and say, what, real estate? Are you crazy? Like, look at the news and look at all this kind of thing. And by the way, Sasha, I'm looking at my portfolio and it sucks.
Yeah.
Right? So now you wanted me to buy something else. Well, there's two things here, right? Like one, yeah, the portfolio at a point in time, as you're marking your revenues down to what they are today and your costs, everything looks terrible. Of course it looks terrible. Costs are 20% higher than they're going to be in 2 or 3 years, and revenues are 20% lower than they're going to be in 2 to 3 years. So do that math, and today at this point in time, everything looks terrible. But you got to be able to see through that and look at your next incremental dollar and say, well, am I buying at a time where I think costs are going to get better or worse? Am I buying at a time where I think revenues are going to get better or worse? And I think unequivocally in my mind, revenues get better and costs get better. Now's the time to be buying, right? It's almost like dollar cost averaging on a stock.
Yeah.
It's maybe a bad example, but like, you buy a stock and then it goes down by 20% and you kind of feel crappy, but you believe in the company and then you go buy more. And then good news, you've averaged your cost down. So when the thing rebounds, you made a lot more money.
Yeah, you buy on the way, buy all the way down. For those of you that don't do that, it's like you're here, and then as the stock goes down, you're buying on the way down, so your average cost goes down. A little easier on a stock than real estate, but it's the same concept, right? It's a very similar concept. So then, what would make Greybrook bullish today? What would change? Or are you bullish? I know you guys are still crushing it. I know you're still you're just releasing a new fund, a new asset class or strategy. Tell me about that. You must be very confident or bullish on that. Tell me about what Greybrook, the moves you've made over the last 12 months, and the new fund, the new strategy you have, and so everyone can hear, like coming right from somebody who has the team. Here's what we've decided to do, because whether the market goes up or down, you can still make money in real estate. We're still real estate investors. So what are you guys doing?
Yeah. So are we bullish? Yeah. Just like I said, I think now is the right time to be buying. I think in Canada with development, it's still hard to find land at the price we're willing to pay today. Okay. It's because sellers, they don't adjust that quickly at the scale we're talking about. And what I mean by that is, like, if somebody owns a $50 million property in the middle of downtown, it's probably not their last $50 million, and it's probably not the liquidity, they're not looking for liquidity out of that per se. So they're not going to just capitulate, because they know all the same things we know to a large degree. And they're sitting there saying, okay, well, why would I sell it to you now at an ultimate bottom? I'm gonna wait until things get better, and I'll sell it for 50% more than I can today, if they can hold on. So transaction volumes in development haven't really been there. It's not that we're not bullish. We're looking every day. We're trying really, really hard to shake loose sites, to find some distress if we can find it out there. And I know it sounds bad, but take advantage of situations where people can't hold on to the land any longer. So our transaction volume in Canadian development over the last few years has been very low, but it's not a reflection on whether we think we should be buying it based on everything we've just talked about and the fundamentals and everything else. It's a question of, we just can't find it, right? And so that's the situation. The strategy we're launching in the US is a bit of a, I would say, slightly different than something we already do. Right now, we already buy apartments in the US, and we do something called value add, where we'll buy things that are typically older. We will renovate them and kind of bring them up to market standard. And obviously with that, we'll migrate the rents upward. We think that over the last year or two, there has been a new opportunity that's kind of come to market, which is to buy things that aren't necessarily the older, rundown type stuff. And it's not the newly built, brand spanking new stuff, which is at a much higher cost base and has to charge a much higher rent. But it's that stuff that's right in the middle in cities that are less expensive than the Miamis of the world, than the New Yorks of the world, and the Chicagos of the world, but that still have 1 million people in them, 1.5 million people, 2 million people, have an ecosystem, have employment. And where cap rates have gone because of the interest rate environment is you're able to go in today and buy some of these things at a cap rate that is at a spread to your lending rates. And that spread you lock in, and now you have positive cash flow at the project level, property level. And our view is that if we can buy things today at a low point, we believe, in markets that we think are growing, that are less affordability challenged than some of the larger markets in the United States, because they're net inflows of people now. Like if you look at statistics, more people leave New York than enter New York. More people leave San Francisco and Chicago than they enter San Francisco and Chicago. Why? It's not politics. It's the fact that these cities are expensive, right? So people are moving into the Oklahoma cities of the world. They're moving into the Atlantas of the world. They're moving into the Dallas, Fort Worth areas and things like that. So the idea here is to be able to buy these things at a price that the market has not yet reflected, right? Those cap rates are still decompressed. Buy them now. You lock in your financing over a long term to be able to have a spread. And now that asset is generating cash. I can pay a distribution while we wait. And if we're right about the macro, you're going to see rent growth and you're going to see potentially cap compression. And that should give you a very handsome total return over time with what we think is a very good risk profile because we're buying things that are cash flowing today. So that's something that I think is a point in time, right? And, you know, I always say a lot, you have to be, I don't know what this, I'm going to butcher the saying. You have to be lucky to be good and good to be lucky, if that's the saying. But the point is, we're launching this today. This has been in the works for about a year. You know, had we done this 4 years ago, we'd be in not as good a position as being able to launch it today based on where values have gone. And it's not because we have a crystal ball and said, you know what, we're going to wait 3 years to launch this strategy. It's not that. But at the same time, we're going to take advantage of this point in time as an entry point. And that's kind of where we're focused. So in Canada, we're looking at doing the same. It's just a bit harder to do in Canada because transaction volumes are much lower here. And there's a couple reasons for that. In the US, the composition of ownership of real estate on the residential side, there's a lot of private families, there's a lot of private owners, there's a lot of family offices, and there's tax advantages associated with selling assets, right? They have something called a 1031 rollover. So if I own a building and I sell that building, all the money I get from there, if I buy another building within a period of time, I defer the tax. So people are incentivized to basically sell assets, buy new assets, and there's a lot of those players around. Canada doesn't have any of those things. And at the same time, the composition of ownership of apartments is 99% institutional. And institutions are patient, right? Pension plans, insurance companies, the Greybrooks of the world, we're all just holding on to these things. So the idea here is in Canada, there's just not an abundance of transactions to be able to take advantage of like there is in the US. And that's why, as well as the macro, and I should say the thing about the United States that Canadians should hear, you know, there's a lot of people that are heavily exposed to Canada for obvious reasons. And sometimes you talk to people about the US, particularly now, and they say, oh, I don't want to invest in the US, you know, a lot going on. If you look at net capital inflows into the United States, they're positive all the time, meaning the world invests its money in America. Canada, foreign direct investment is negative, actually, right? So we still invest heavily in Canada and are going to continue to. But the point I'm trying to draw is that the US is the largest, most liquid, most abundant market in the world. So we all should have exposure to that market to a certain degree for those reasons, right? And so the idea here is that, you know, we're going to have a balanced strategy. Hopefully there'll be more Canadian product that we can shake loose over time. But for now and kind of the next 6 to 12 months, at a bare minimum, our focus will be on trying to acquire these properties in the US.
Okay, that's good to know. And we've always said invest where returns are best, right? When we work with our investors, Sasha, we coach them through start close to home because you know that area. But if close to home doesn't work, you're an investor. You got to invest where returns are best. And I think it's just a great example of how your firm is adjusting and making that happen. And just going where the money is, going where being the smart money, that going where the opportunities are. So this activity you're doing, is this something that's just within Greybrook, or is this something that's available to the public, to investors as well? Like, can people come along for the ride with you?
Yeah, of course. It's available to investors. It's a little bit different than what we've done in the past. Like for those of you who are listening that invest with us, we do things typically in a single purpose type of entity, right? We buy a deal. It's a closed end type thing. There's a beginning, there's an end. Obviously, over the years, the end has been drawn out for all the reasons that we kind of know. But the idea is that there's no liquidity in the meantime. This we're going to do differently. We'll do as an open-ended fund. So it's a pooled vehicle. All the properties are going to go into the fund. There'll be liquidity on a regular basis for people that want to redeem their units and want to move on and do other things. It'll have a cash flow component as well. So the idea here is that it will resemble a lot more of what I think we've heard from our investor base, right? Like, man, I wish these projects were a little more liquid because I'd like to get my money out. I wish there was a cash component while I'm waiting. And unfortunately, in development, that's just not achievable, right? You have a hole in the ground. Like, where's the cash going to come from unless you're manufacturing it through your financing and how you're putting the deal together, which we don't like doing that, right? So the idea here is part of the strategy is it's the right time to do this exact thing, but part of it is trying to listen to our constituents and our investors and what are they looking for? Like, man, I'd love to complement some of my development with a yield product. I'd love to complement some of my development with something that I can get my money out if I needed to. So we tried to marry the two and pick the right strategy, but create a vehicle that, I think responds well to what people have been looking for. So for sure it's available. We literally, I think just if we haven't launched it, it'll be today, but maybe it was yesterday. But yeah, so you guys will be hearing about it, I think soon.
Cutting edge. There it is. Today or yesterday, within
You might be
24
the first.
hours.
You might be the first people to hear about it. And if we haven't actually launched it, I've stolen the thunder of our
Oh,
capital
you're going to
markets
be in
team.
trouble. Someone's behind the camera being like, "Wait, we have a whole plan.
Yeah,
Stop,
exactly.
Sasha. We have a whole
Don't
plan." Well,
don't
thank
don't
you.
tell anybody.
Thank you for sharing. I'll have my team put your team's booking link or some contact information if you guys
Well, you
want to
guys
learn
will get
more.
your usual thing too, right? Like, I mean, our partnership goes back longer than 10 years. You said a decade. I think it's been closer to 15. We're old, Michael.
2010, I think, is when I met Peter at
There you
Tim
go. We're
Hortons.
to year 16. So the idea, you guys will get access just like you always typically get access.
Sounds good. Okay, thank you, thank you. A couple more questions, and then we can wrap it up. There's a question here in the chat I want to get to. Steven has a question. He always has great questions for us, and I think we should tackle this one because he says one question I never hear being addressed is this: is what being built or developed, sold, promoted in line with what people need? So you and I, Sasha, just talked about, well, there's this big,
Yeah.
we're building all these things, and then one day somebody's going to want them. Steven's saying, well, what if they don't want them in 5 years? What if they're not the right asset, not the right product that we're manufacturing for people? The average person cannot afford extreme luxury, let alone at a monster scale. If we look at a post-war home, the homes are smaller, a little bit more manageable financially, and compared to typical subdivisions. And I'll just even add, Stephen, to your perspective, to me, it's not only the monster homes that are the issue, Sasha. I read a great article about how the McMansions are dead a little bit. Anything over 5,000 square feet are not there anymore. But it's almost more like the smaller condo units.
Yep.
I know you work with this, you address this, but 500 square feet, 600 square feet,
Yep.
is that actually what people want or are going to want? Like, what's the answer to that? Could we have all this supply, but it doesn't meet the demand, and now we have a bunch of people unhoused and we have a bunch of empty houses? Is
Yeah.
that possible?
No, listen, Stephen, that's a great question. So let me try to address it in a couple of ways. So firstly, on the low rise side, I would say by and large, it's an end user driven market. Like, so you're building something that is most typically bought almost every time, if not 9 out of 10 times, by the user, right? Like somebody who is going to buy it to live in it. So you
What's
are,
low rise? Sorry, Sasha, just for the
oh,
development
sorry, yeah.
language to the audience, what would low rise look like if you're driving down a neighborhood?
Like a single family home or a town home or kind
Got
of a
it.
stacked town home. So like think about like anything that's not a condo. Okay. So like these smaller typically we think of them as ground related, right? So you have a driveway, you have, maybe a backyard kind of thing. And they can be,
Front door. You got a front
yeah, they
door,
can be
right?
low
Not a hallway.
density, like in the sense of a single family home. I'm not talking about like a mansion, just like a regular kind of 30 foot type house. It could be a semi or a townhome, or it can be something we call a stacked townhome, which might have a couple of levels and kind of a staircase. It's not an apartment building, so it still gives you the feel of living in sort of a stick-built home, accessibility, all that kind of thing. So that's what we would call low rise. And that's stuff you sell to end users. Okay. Why? Because the delivery time frame
Mhm.
is generally short, right? So if Michael is making a decision to buy something, it's usually event driven, right? Something in life, right? I'm moving, I got married, I have a family, whatever it is. They're not typically made in like 5 year long increments, right? So end users typically gravitate to these types of products because they can get them in 12 months, so to speak, or 16 months, or whatever that time frame is. And there's different sizes. Like you can have a 1,500 square foot townhome, right? And different price points. Now you have to go a bit further afield, and that's why everybody has kind of moved to the Richmond Hills, the Markhams, and even Miltons and things like that, if they're looking for that ground related product. So I think to answer your question, Stephen, I think on the low rise side, it is probably exactly what people need and are looking for, the product that developers deliver. The high rise side, I think, is a little bit different. And the reason is that the financing model for high rise requires purchasers, right, that are buying pre-construction, and their deposits make up part of the equation as it relates to how these projects are capitalized. And it's a requirement for the bank to be able to lend the money. Okay. So for those reasons, you have to conform more to what an investor is looking for than what a end user is looking for. Not always. It's always a mix. Okay. So every condo you build, you're going to have 2 bedrooms, 3 bedrooms, you're going to have those units. But by and large, the majority of them are going to be 1 bedroom or smaller units because they are aimed at what an investor is looking for. Why? And right now it looks like, oh man, we've got it all wrong. The whole model's wrong. I would contend that it isn't, and I'll tell you why. That investor is looking to buy something and usually rent it out. Our entire rental stock is comprised of condo for the most part. Because purpose-built rental until now, because everybody's now talking about it because the condo market really isn't available, right? So people are talking about rental and governments are talking about how to get more rental buildings built and things like that. But for the better part of 20 years or more, you've only had really condos built that service the rental supply. So right now it looks like there's this oversupply of units that nobody wants, only because the rental market, we've shut off immigration for the large part, right? So the rental market isn't as robust. The demand isn't as robust as typical. And end users who are the buyers, right? Somebody that wants to buy a more affordable format of housing, they're not able or they don't want to buy this 500, 600 square foot unit. And there's not enough of these 2 and 3 bedroom units. But if you look at where the transaction volume is happening right now in condo, it's the 2 and 3 bedroom units because end users are actually buying those. That's the market we're in. But once rental ticks up again, there will be absorption of those smaller units, right? They're all going to be rented out. So I do think that we can improve the ratios, right? Like we can have more 2 bedroom units, more 3 bedroom units, less 1 bedroom units. But we still have a tremendous need for these smaller units because it services the large demand for rental in the city of Toronto. And what I would say is we focused on buying things in the core, like our acquisitions are in the core of Toronto typically, or on transit hubs, right? On subways and different things like that. The reason is that because the type of buildings we're building are geared to renters, right? Now, if I bought a condo site in Guelph and built a whole bunch of 500 square foot units, I probably missed the mark on what the market is looking for in Guelph, right? Which might be a more end user driven product, right? Where people are looking to actually live in those condos and be able to accommodate families. So where do we go from here? That's another important question, because I think the investor universe in pre-construction is going to take a little bit of time to come back, right? Because those economics have to start looking attractive again before pre-construction investors want to get back into the market. I think that more rental buildings will get built. I think it requires the government to start reducing some of the costs, as we've talked about. And it might even require lenders to get a little more innovative with how they lend, right? So rather than requiring developers to have their 70% pre-sold inventory in order to be able to qualify for a loan, lenders might sit there and say, you know what, there might be more demand for end user driven product, right? Not buy in pre-construction 5 years from now, but rather build it and somebody will want to buy it because it's a 2-3 bedroom unit and we're comfortable with that demand. So maybe we will lower that threshold so you can have less of these rental units, right? Get into construction and then have more of a balance of the inventory left over to sell to those end users. And that's going to change the composition of these buildings. And that's something that, I can't speak for the banks. I know there's lots of discussion going on around that. What role can government play in potentially solving that other, because if the bank doesn't want to take that incremental exposure, right? Maybe there's a way for the government to play the role there. So I'm involved in some of those discussions. So the idea here is that I think it's going to change. I think it's going to change for the better, but I don't want to make it sound like it's been done incorrectly, because it's been done correctly to service a very, very large demand for rental, which is going to tick up again.
Excellent. Stephen, thank you for the question. Sasha, great answer. I love it. And we're gonna see. We're gonna go with the market. I think a theme of my life and the way I like to live my life is something that you've mentioned, is there's things that we can't control and there's things that we can control. And I'm always a believer we have to be aware of the things that we cannot control, but we don't lose sleep over them. And we focus on the things we can control. And I think what you've explained today is exactly what you guys are doing with your team of 150 plus people. Is let's focus on the things we can control. Let's find the markets. Let's find the asset classes that work. And let's put our efforts there while we're still being aware of all of these other things happening. And it changes. It changes every 3 months. It changes every 6 months. And so just being aware, listening to smart money, listening to different perspectives, not having one single source of truth when it comes to this as well, Sasha, right? It's like, you and I are going to have one perspective and someone else will have another perspective. And your job as the investor is to take all of these and make a decision that's great for you. So I encourage you to continue to listen to these things. Sasha, last time we spoke, people asked to have you back more. I think we should do this again in a few months. Check in again. This would be the third in our series today. I mean, we've been doing this over a decade if we want to go that far back. But in terms of this conversation, let's get our teams to plan a fourth for us in maybe 4 or 5 months. Deanna gives us a heart, says yes, and we'll see where we're at. I mean, we could be dead on right, or things could change. There could be another war. Like, we don't know. So stay tuned, stay engaged with us as an audience, and Sasha and I will always commit to bringing you the best we can as much as we can. Is that fair? Sasha, good idea.
I would love to do it. Thank you.
All right. Thank you, everyone, for joining us. That's our time. We're going to put links around this video so that you can reach out to Sasha's team and get more information, contact his team, and then links to the other videos so that you can continue to watch. Awesome. Sasha, have a wonderful week. Great to see you.
Thanks,
Hope I see you
guys.
again in person
Thanks, everyone.
soon. Thanks, everyone. Bye, everyone. Have a great day.